So, are you trend following pudgy penguins? I saw an ETF filed, maybe, perhaps. I swear to God.
Yeah.
So there was a headline, a tweet yesterday going around that it sounded like a joke, but it was not a joke. It was like sneaker discovery in space for the blockchain. Did you see this?
Wait, what? What do you mean sneaker discovery in space?
A footwear startup is teaming up with 2 space companies. Okay, so let me read it over. A footwear startup is teaming up with 2 space companies to design a shoe in orbit as part of a mission to make artificial intelligence and blockchain less expensive and more eco-friendly than it is on Earth.
Why does anyone need this?
That's a Bloomberg article.
I feel like I would need to be high.
Where are the mushrooms?
Are you bullish on that though? Generally,
yeah, it sounds great.
You got to see this. You got to see the specifics, but it sounds good.
I've learned in the world that we live in today, the crazier and dumber the idea sounds, like the better it's probably going to work out.
The company's called Reblockchain.
The degenerate economy.
Reblock. It's amazing.
Unbelievable.
What's the story? I always wonder. I see the videos. What's the story with the?
It's the dumbest thing ever. Hold on, let Josh explain.
We're all avid croquet players, so.
Oh, they're not bocce. They're croquet.
These are not bocce.
Okay, I always thought they were bocce.
Not bocce balls.
What's the story? Curb Your Enthusiasm?
No, dude. It's a visual motif. We have.
That's right.
We have behind us the same colors that are in the foreground.
Nicole's cackling. It's a motif.
Can I ask you a question, honestly? Nicole, stay here.
Yeah.
This is about to be insulting.
No, it's not. Not to be a dick. And most sentences that start that way are not great. Not to be a dick. Can you imagine if you designed the room that we record the show in? No, honestly. It would be like it would be a college Bob Marley poster, blacklight poster, maybe Pam Anderson on the wall with one piece of tape missing.
She was my number one.
Right?
Yeah.
Okay, we'd be sitting on milk crates. No style.
Yeah.
Speaking of style, John, I like your style.
It'd be like an alien, some alien thing would have to be there.
You'd be like, whatever, it's a podcast. Who gives a shit?
I'm not a stylist. Josh is right.
Come on. Like, we gotta, there's gotta be some judge to what we're doing here. Daniel, back me up as the in-house graphic artist. What we show on screen is important, right?
Yes.
Okay, there's gotta be like a vibe to it.
Yeah, you're right. It's a motif. I'm here for it.
Okay.
For sure.
Do you have alternative suggestions?
No.
I'm all in. I want to hear them.
didn't ask.
It was eye-catching. I always wondered.
You asked the right question. I gave a good answer.
So you might not be aware of this. Let me tell you something that you don't know.
Nothing escapes me. Nothing escapes my omnipotence.
You know the chart that we used a long time ago showing the distribution of returns for individual stocks and how few of them beat the index?
Bessenbinder.
No. This guy.
You? That's your shit?
Originally.
Actually,
did Bessenbinder...
He lifted it from you.
He lifted it from us.
Did he credit you?
Yeah.
Because I'll find that son of a bitch.
No,
all right.
He's a good guy. He actually lives in Arizona, so.
Oh, really?
Yeah.
Okay.
ASU.
Shout
out to ASU.
Huh?
So what gave you the impetus to look at that? What was the question that you had in your mind that you said, I want to research this?
It was kind of a random discovery, actually. We were doing this study on does trend following work on stocks, and we started to look at that, and then just looking at the data, it just was seemed very weird that the distribution was so different than what we would learn in school about kind of normal bell curve distribution type thing. I was like, wait a minute, this doesn't look anything like what I was taught. And
okay,
just kind of
we'll get into that today. I didn't realize that was I knew your paper does trend following work, and then you followed it up. Does trend following still work?
Yeah, we had another paper called the capitalism distribution.
Okay,
and
that was it.
That's where that work kind of came.
What
from.
did he do in his updating of your research that was different than what you guys did?
The Bessenbinder.
Yeah.
He just took it. I think our data went back to in the late 80s, something like that. He took it back for the whole CRISP data set to the 1950s or 30s, something.
So the
longer data set.
So the goal of that is to show people, or the research shows people that most stocks end up being losers in the fullness of time. Is that?
So here's my interpretation, and it's subjective. Most stocks are not worth buying and holding forever, right? Most of the value creation of the United States and all stock markets are concentrated in the hands of a very few. We all know that. My only issue with the paper is that it assumes that people buy at inception and hold forever. And we know that's not good because most stocks eventually die, right? But
That's
there
not
is-
how most people
But
invest.
that's not how most people invest. There are still opportunities. Now, I'm not here to like advocate for day trading or heavy trading, but there are opportunities to make money from the time, in between the time the company comes into the market versus the time they leave. Or, you know what I mean?
Yeah. I mean, I think index funds benefit from it, though,
Sure.
because they own
Yeah.
everything.
Well,
and
they
get
end
kind
up
of-
with the survivors.
Yeah.
Well, the whole conclusion of the paper, not wrongfully so, is index funds are probably the way to go.
I mean, I think for the average person, that's probably
Yeah,
true. I mean, if the average person is better off doing that than like picking stocks.
Yes.
And based upon the math. Like
Yes.
it's not good odds for the average
Yeah.
person to pick a stock.
So don't be average.
Don't be average.
Exactly. Just pick
Yeah.
the best stocks. That's my whole philosophy.
That's all I ever do.
Yeah.
I mean, this is a life philosophy.
Who picks the losers?
that's
Why
why-
would you pick the worst stocks? What the hell is wrong with you? I think there's a lot of people who first come into investing, and their first instinct is to buy cheap stocks because buy low, sell high,
Yeah.
and they think
Obvious.
and they think that that's like going to be their edge. Is like they're going to buy the 52-week low list. It's maybe not the worst possible strategy, but it's got to be up
it's
there.
up there.
It's
It
gotta
might be the
up
worst
there, right?
possible strategy.
Right, but that's the instinct because people think about, oh, in real estate, like you want to buy a building that's cheap,
Yeah, you want
and
a
then
value.
you want value. I think in the stock market, if your starting point is what are the cheapest stocks, like absent everything, you're buying companies where there are chronic issues. A few of them are mispriced and will work, but most of them are cheap for a reason.
Yeah. I think people, when they buy stocks, they forget that they're buying a company and they really should just be saying, what is
Yes.
this company and how much is it going to earn and grow over time? Because ultimately my performance in the stock is going to be dictated by
That's
that.
so true. If you are going to bottom fish, you better be doing fundamental research.
Yeah. Because all
Like,
they're,
and be good at it too.
yeah, because they're just looking at it's down off the high. It's like, well, I don't know.
It's
Was
cheap.
it a good company back then? Is it a good company now? I don't know.
Think
That's what you should be focusing
Warren
on.
Buffett said it. Most turnarounds don't turn around.
Yeah, I agree with that. So I was on TV today. We were talking about JetBlue.
Yeah.
It's a $4 stock.
Oof.
First of all, nobody could buy a $4 stock. Like institutions cannot buy them. There are people that will bottom fish and buy $4 stocks, but what happens is you immediately collapse the universe of potential investors to a tiny slice of people that operate in markets with
I'm
a lot
buying
of
it right
capital.
now.
I dare you.
Well,
Like-
if you ever flown on JetBlue, you know why it's
Fly
a
on
$4
JetBlue all the time.
stock and-
Totally understand it. I wish there was a stock of JFK Terminal 5. I would short it. I just want to short just if I could short the terminal, I would. So
I can't
totally
believe you
get
still
it.
fly JFK. Let's start the show. Nicole, let's go.
The fly out of JFK as opposed to
Just
where?
you avoid it like it's AIDS.
I have to fly in to come here because there's no direct.
It's 20 minutes from my house. Where should I fly out of?
LGA. Every
40
time.
minutes from my house.
Dude,
Nope.
you walk right through.
No.
You're wrong.
No.
So dumb.
I know. I do both. All right. Come on, do it. Say the thing.
The Common Friends, episode 197.
All
Like
right.
you mean it. Today's show is sponsored by Public. On that platform, you can invest in almost everything. Stocks, bonds, options, crypto, ETFs, whatever you want. You know what's great, John? It's been a while that we've had these juicy yields in our cash, and they're still here. At Public, you can get 4.1% in their cash account. 4.1%. Liquid as the ocean. So leave your clunky, outdated platform behind. Public was designed in the 22nd century. That's how far ahead they are. The experience is clean, intuitive, modern design. What else do you need? Find out more at public.com/compound. That's public.com/compound, paid for by Public Investing. Full disclosures and podcast description.
Ladies and gentlemen, Miss Nicole. All right, we are live. This is the #1 investing show anywhere. I don't care what you've heard. I don't care what data you've seen. It's not true. We have a very special guest today. I'm so excited to introduce him to all of you. He is a first-time guest here on the Compound and Friends. His name is Cole Wilcox. Cole is the founder, CEO, and CIO of Longboard Asset Management, specializing in alternative investment strategies. Cole has over 20 years of investment experience building alternative investment portfolios. Cole, welcome to the show, dude.
Thanks for having me.
What part of Arizona are you from?
Scottsdale, Paradise Valley.
You grew up there?
Yeah, born there.
You did?
Third generation native.
Oh, wow. Okay. I want to talk to you about your initial market experience because I think you and I are the same age.
47.
I'm 48.
Yeah. I'll be
So
48 in September.
So I think we've like started investing in 97, 98, 99. Like that's my formative years, unfortunately,
Yep.
because I'm locked into that paradigm mentally now. But it seems like you probably had a similar experience that I did just in terms of like the stock market and what was happening in those early years. Do you find yourself to be ever defaulting back to, well, back in 1999 as often as I do? Because I struggle with that.
Not 1999, but the whole cycle of if you've gone through that kind of boom bust multiple times.
97 to 02.
97 to 02.
Yeah.
You had a bust, a boom, and a major bust after that, and you saw people get rich. You saw people completely get destroyed, and the impact that it has on their lives. So I don't think that's embedded into your early like DNA. Like those people who grew up as depression babies, like they experienced that. It affected how they think about life. For me, it affected how I think about risk, how I think about the risk that is involved in investing. And, to be realistic about these sequences, because I've lived through it. If you didn't live through that cycle, what came after that, it was
Well,
not the
so
same.
here's the problem for me. So in 22, it looked very similar to the early stages of 2000, 2001. And we ended up with a 35% bear market in the NASDAQ that I thought could be negative 70% because I had that experience. And, there's this idea in the markets where like your experiences contribute to this like long-term market wisdom. And I think there is some truth to that, but also
I don't.
Okay. So I want to hear why in a second, but they can also negatively color the way that you look at things, and you are looking for analogies all the time. Like this looks just like that. So when I'm living through 2022 and I'm seeing the IPO bubble burst, all I can think about is it's early. It's early. This is going to go way lower. And of course it doesn't. But I know exactly why I felt that way in that moment because I lived through it very early and it was formative.
Yeah. Well, I think it's very natural for people to build those biases, and their experiences build biases. And it's very dangerous to invest or reason by analogy in anything. It is a known thing. So I know that, and I know my own personal biases. And that's why I focused on building systematic strategies, because I'm just like any other human. I have those real things, but a systematic approach doesn't have that memory.
Exactly.
And that's the major benefit of it.
It has that memory, but you're coding it in. Like it's a systematic approach based on historical volatility and returns. The memory is there.
No opinions.
The opinion's not there.
Yeah, it's the math is there. It's like you just what is statistically the most probable. You don't talk yourself out of it, after you do the math, which is, I think, where the biases come in. Well, I think it's different this time when it's not different this time.
But what are you saying? You're saying that people don't have those biases?
I'm saying they absolutely do, and it hurts them. So
okay. So nobody disagrees with that. We all agree.
No, I'm saying that I think that experience and wisdom in life are great. I think in the market, it can be treacherous. I think it was Peter Bernstein's book who wrote about how, was it Bernstein? I can't remember. In the 1950s, when the yields of bonds crossed above stocks, anytime they converged, it was a sell signal for stocks. Stocks got too expensive every time. It worked historically like 10 out of 10. It was like the yield curve indicator. And then one time it just stopped working and it never worked ever again.
Yeah.
And then forevermore, bonds yielded more than stocks. And I think that once you have that muscle memory, things change a lot over time. And especially if you have a traumatic experience early in your formative years like you did, you see that every time stocks fall. And I think that, yes, there are positive lessons that you can learn from your own history. But I think people over-index to what happens to them earlier in their career.
Overrated in
Totally,
investing.
because people become experts on an earlier version of the world. I'm stealing that from somebody, I don't know who. And I think that's what happens, and it stays with you.
Well, it's also the own internal ego. Like you overemphasize your own personal experience, and that's all you know. If you're able to do back testing and run research and look at 100 years of data, then you get all of these other lifetimes of experiences that you can contrast with your own personal.
Mm-hmm.
Like it extends the data set, with which you can evaluate what you want to do. I think that's the issue, is that people who don't have the data and can't do that research are not able to build a more balanced viewpoint of reality.
I think
approach it.
valuations too, like where your experience is your worst enemy, because companies have gotten better at being companies, and as a result, we are systematically paying higher and higher multiples for earnings. Like we just are. There's a lot of fundamental reasons why. There's a lot of macroeconomic reasons why. And a lot of people got anchored to the PE ratios they remember as being a stock market bottom.
Or margins mean reverting. Margins were a very mean reverting series historically, and then came the tech giants that just ripped that up. So that doesn't exist anymore. How could you have known?
Right.
And so when you see, I think the most wrong people on TV are when people say, I've seen this movie before. No, you haven't.
Yeah. So like if you think about like an early 80s paradigm where the S&P bottoms at 10, right? It's like, well, stocks don't bottom until we get to 10. We were never going to get to 10 times earnings. There's too much money that needs to be invested in stocks. And there's a different investor populace now with a higher risk appetite. And they're earlier in their investing careers and have a high, and just, they're not anchored to like those historical moments. And so that's the thing where I have to check myself the most often. It's like, I think this because I lived through it, but it doesn't always have to be the same as things used to be. And we're going to talk a little bit about cycles and stuff like that, because I'd love to get your take on this concept. But in addition to the fact that the markets change, the people investing change, businesses change, the speed of the world is completely different than what it was in the era where it was phone calls and snail mail.
Yep.
So we should expect cycles to speed up. So this is where I want to start. Am I imagining that we're having 1 month recessions and 1 week bear markets, or do you feel the same way?
I think it feels that way because of the news cycle and social media, and it speeds up how we feel about the markets.
Yeah.
But I don't think it's any, just different than the time that it's ever been. I just think the speed at which information gets diffused and reacted to is at just a higher amplitude than it used to be.
The V-shaped recoveries are different, though. Like, that wasn't a feature of markets in the 80s and 90s as information took longer to disseminate amongst investors.
I mean, I think it feels that way. In 1998, huge V-shaped recovery, right? We thought we were going out of business with long-term capital management. Less than 6 months later, we're back at new highs.
Yeah.
So flash crashes, even in this cycle, happened like
2010.
Flash crash, market's down 8-10% intraday. So it's been there like the whole time. The quant crash, there's different things that you've seen, different cycles that have happened. So, but I agree, it feels that way. I just don't think it is really different.
Does it matter who's in the marketplace? Because one of the things I think is that if you have a huge wave of younger people who at the margin are controlling what stock prices do, and they're not saddled with any of this baggage of 2-year long bear markets like 2002. Like they don't have that as part of their history or their experience. They are more willing to buy those dips, and they're more willing to turn a dip into a V-shaped recovery because they can't imagine a scenario where the market spends 2 years pricing in bad news. So I've lived through that, but that's in an analog time. And now everything's digital. And it's like, all right, here's the news. It's bad. I sell something the next day. Okay, I guess I'll buy something else. I feel like it's who is in the market that's contributing to the V-shape more than anything else.
Yeah, well, I think that the younger generation, despite the bad rap that they get with the degenerate economy and leverage trading and daily options, I actually see investor behavior being the average like young person who's a serious investor is a better investor.
Oh, definitely.
Than before, because they should be. They have more access to information. They see what works, what doesn't work. There's just a lot out there where their behavior on average, I think, is much better than young people of the 1980s.
Definitely.
They're more informed.
The wake-up call to that was like the response to the spring 2023 bank runs, right? They didn't budge. Like Vanguard data, nobody sold anything. Like I don't know who was selling, but it was not the retail regular investor. They just like lived through it, and they were just like, whatever. I don't think that you could have said that about prior eras. In the financial crisis, people were actively selling stocks in 401ks. They just don't do it anymore. And I think it's because they've built on the experiences of the past. People learn lessons. They learn what happens when I panic and I do all these things to my long-term investments. It looks stupid after. And now I don't think anyone does that anymore.
No, and when they don't do it because it's paid them not to do it. You know, we've been in a prolonged bull market. Buy the dip, you know, has worked. And until it doesn't work for them, I think you should expect them to continue to do that. They're not going to proactively change and like, oh, I need to think about what might happen in the next 1997 to 2002 cycle. I'm just going to react to what my personal experience is, which is buy the dip works.
So we never had the 97 to 02 experience. But what we did have a 20-month bear market where their favorite stocks lost 2/3 of their value and they didn't leave.
Yeah.
Like they're still in the game.
When was, what is that, late 21?
2022 to the bottom of, it was October 23. It was January 22. That was when we topped. And we bottomed in October of 23. So that was almost 2 full years of pain.
But they've had more pain, I think, also outside of the stock market. Think about the pain that they experience in Bitcoin, right? Like multiple 60. They're just not like, they're not phased. They have the laser eyes. They're just locked in diamond hand owners of stocks for young people who are really serious about investing these days.
Yeah. I think that's cool. I like that the Gen Zs kind of kicked the door down during COVID. That was their moment where they all discovered investing all at once. Like, it was an amazing thing. The amount of brokerage accounts that were opened in 2020 and 2021 broke every record we have on the books.
And stayed open. They didn't leave.
They didn't leave, but I'm just saying, like, I can't think of another time where an entire generation all started investing at once. And that's what they did.
And they have the tools. Think about the tool, like Robinhood. My son who's 15 and all his friends have Robinhood accounts. They trade, they're investing.
Oh, yeah, and they start so much younger.
So much younger.
And Public, shout out to Public. Sponsor the show.
Yeah.
Right.
Screw Robinhood, Public.
Right,
Cole,
I agree with that.
Does the story, so you've been in this business for a while, talking about systematic investing, removing the biases. Like, this is a good way to insulate yourself from the what should I do? Because we'll just listen to the market. Don't worry about your opinion. Your opinion, everybody else's opinion, it's in price. And there are trends. We follow them for better, for worse. It's not perfect. There's, like everything else, there's no perfect strategy. But does that story resonate more with investors today than it did in say the early 2000s when it was still sort of a novel approach?
Oh yeah, for sure. I think alternative investments in general, especially after 08, because like the people saw the benefit of having alternatives, and 00 to 02 helped. 08 really put the hammer down of like, you really should have these diversified portfolios with other risk management strategies, things that have low correlation. You can't just rely on stocks and diversification across a wide portfolio of stocks, because it can all just go down at the same time. Your stocks and bonds can go down at the same time. Your stocks, bonds, commodities, and real estate can all go down at the same time.
Yeah.
So
08 was really,
it was really,
everything,
for those people.
Everything broke.
Yeah, there was no place to hide.
Even gold. People forget that gold rallied after.
Because in the liquidity crisis, everything, is going down. It's just a giant sucking sound for liquidity.
So let's talk a little bit about your investing philosophy and how you actually invest. And then I have some questions based on that. But let's just set the table for the listeners. Who is Cole Wilcox, the investor?
Cole Wilcox, the investor, is somebody who believes in a diversification, right? You need to maintain a diversified portfolio. I don't think trend following is the only thing that you should have in your portfolio. I think it's a piece of a well thought out strategy that is designed to compound wealth over time, protect you through all the different market cycles, knowing that you're probably not going to be very good at predicting what's going to come. So build something that can kind of get you through everything. And most importantly, and this is where I come at as an investor, the most important thing in investing is to remove the double zero from the roulette wheel of investing. That the 08,
the wipeout.
The wipeout, where you've made all of these bets, you bet every number on the board, but you still lost because it hit double zero and they take all your chips. You have to build something that removes that, because if you do it, then you've already won, right? Over the long term, you just have to run your strategy and do what you need to do. And I think that for what I do and our philosophy of trend following and kind of our approach is an excellent tool for removing that double zero from your portfolio.
Why? How does trend following help you do that?
Well, it's two ways. One of them is just the most important thing is avoiding permanent loss of capital in investing. And while the young people wouldn't agree with this or see it because they only have their data set, I can go back 100 years, 200 years, look at the cycle of the stock market. There will be periods of time of absolute horrific pain as an equity investor. We have asset bull markets, we have bear markets, we have occasionally once a generation a depression. I don't know if that is going to happen, now or next year, but it will eventually happen. The trend following does an excellent job of kind of removing the highly destructive permanent loss of capital in those massive drawdowns at 20 to 60%. And more importantly,
How does it do that?
Well, by preserving capital. So it's a capital preservation strategy that as we kind of rotate, as trends change, we're rotating more into low correlated treasury bills and preserving capital and just reducing the drawdown, right? So if my drawdown's only 20, right, I only need a 30% return, get back to new highs. If it's 50, I got to make a 100% return to get back, to new highs. So you're putting yourself ahead of the game by playing very good defense in bad markets. And just mathematically. The second part, I think, is even more important, goes back to the behavioral aspect of it. You're getting invested and you're able to stay invested and stay disciplined because you don't lose so much money. You don't go down so much that you deviate from your plan. Like, I can't tell you how many people I saw deviate from equities, like boomer generation in 2008. They just freaked out. Like, I can't deal with the pain anymore. I'm concerned that stocks are going to go to zero. And I moved to bonds or I moved to something else, which is super destructive. It was a bad timing. It was a wrong time to panic. But going down, we know psychologically human beings just don't like losses. And the worse it gets, the more painful it is. And then that changes your behavior. And that's the worst thing you can do is deviate from a plan.
So we built a trend following strategy in-house. Michael did most of the heavy lifting because that was the question we were trying to answer. How do we keep people from blowing out their entire portfolio in one of those types of market moments, which admittedly are rare? How do we make sure that people just don't throw everything away because of a moment like that? And to us, there's a lot of answers. We looked at a lot of other people's answers, but the real thing is, like, when you are in a slow crashing market before it becomes a fast crashing market, take some exposure off. And client by client, it varies how appropriate it is, how much you need to do that. The question is not, does a trend following strategy help investors hold on to their portfolio? The question is, what is the cost of it? Isn't that like the hardest part of what you do, is like, hey, this ain't going to be free. There are going to be markets where, because we're trend following, there might be a whipsaw. We might have to get out of something and then buy it back higher. Like, what's the cost of that relative to other ways to hedge risk?
Yeah, and and for me, it's two kinds of cost. There's like real mathematical cost, like you actually cost you money, and then there's the emotional cost and the psychological cost of doing stuff where it's more in your head. It's not in your head, not really in your wallet over time. But they matter, because if it's in your head, it affects what you do, and then it affects your wallet.
Yeah.
Yeah. So that's that trade-off of, is it worth doing? What am I giving up? What am I gaining? What do I have to pay in fees? What am I getting in return? What's the value proposition there? That's the most important, kind of question. I think it depends on who you are, what your priorities are, where you're at in your life cycle. And you just got to, for some people, I would say trend following will make any sense for them. Like
if you're 20 years old, you should be buying more when this would trigger a sale.
Yeah. And it just doesn't matter.
It's the dollar amount that you're protecting.
And how much time and duration you have. Maybe if you get whacked and you lose 50% in a stock when you're 20, maybe that's a good thing.
Buy more. Keep buying.
Or it's a good lesson for you to learn and kind of go through time, so that you'll not do those kinds of crazy risky things in the future when you have more money and when you have no duration left to kind of figure it out.
So a couple things that attract me to trend following, and I agree with you. It works as part of a broader diversified portfolio. It works really well in concert with strategic asset allocation. Two things. Number one, it gives you the ability to ride a bull market, which is really hard. And especially if you are an advisor and you are telling your clients this part of your portfolio is going to protect us to varying degrees from downside deviation, if that portion can't survive a bull market, it's dead. It's worthless. If the market is doubled and this thing is flat, clients will never stick with it. So it allows you to stay fully invested when the trend tells you to. Number two, and perhaps more important, is the buying back in. Trend following, we just experienced this. We bought back higher. It's not fun, but it doesn't matter that it doesn't feel good to buy back higher, but it's a lot better than waiting for a return to previous levels that just never happen, right? Like, so if you were a trend follower and you sold in December 2007 and you got back in March or whatever, or April, May, this gives you the buy signal objectively and unemotionally. And getting back in after you've sold is almost impossible.
Yeah.
If it's discretionary.
Especially if you sold it, especially if you sold at a loss.
Impossible.
Yeah.
Psychologically, people
Impossible.
don't do it. I
Can't
mean,
do it.
there's all kinds of psychological studies that prove that this is not what the average I mean, there are some maybe non-normal people that deviate from this, but for the general bell curve of the population, it's not going to happen. They shouldn't be doing it. They're just going to get themselves in trouble with it.
I also think trend is the least bullshitty, way of deciding whether or not I'm buying and staying long or I'm getting out. Meaning, you could have all these formulas like where you look at the Fed model of like, earnings versus like what the yield is on a T-bill and all this shit. You could have economic indicators that are subjective.
Price gives you everything you
The
need to know.
economy changes. If you just focus on price to dictate whether or not you're buying and selling, you're pulling in the sum total of all of those other things. It's reflecting everyone's opinions about everything. How could it not be the least bullshitty way of doing it?
Well, not only it's bullshitty, it's also engineering-wise, just the principles of engineering is like the most elegant, right? It has the least amount of variables. It has the least amount of moving parts. It has the least degrees of freedom. So and you're not going to there's a lot of different ways to come up with all these correlation, here, there, and stories you can tell yourself.
Magazine covers. There's a million different things you can look at.
But the price is the price. It's also you're investing and you're taking signals and you're doing something off of ultimately what is the fundamental principles of accounting. If it went up, you made money from an accounting world. If it went down, you lost money. Like that's what's going to determine whether or not your P&L was positive or negative. All the rest of the stuff is just a narrative that ultimately you can trade off of those narratives, but it's still going to come down to price and whether or not it went up or down as to whether or not you're, what the value.
So
of the thing is.
we've always thought that way. When somebody makes a statement, price is truth, it's not the same thing as saying the price is right. The market overprices and underprices itself and assets every day. We're not saying price is the absolute correct price all the time. Price is always the truth of how people feel about the market because that's where they're buying and selling.
It's what the market's expectations are at any point of what's going to happen in the future. But like any prediction market, the expectations can be wrong.
They move.
Yeah.
They can be right. They could be correct odds. They're just a representation of the odds. That doesn't mean that they're setting the odds correctly.
Yes.
Yeah.
They're going to be wrong less times than you are if you're just making it up. I think prices are wrong. Okay.
Yeah.
Do you believe in technical analysis in general, or are there areas of technical analysis where you say, all right, I get that there are some people who focus on this, but I've been able to throw that out because it's not really important to what I do?
I don't want to knock the technical.
No, we're trying to
side
get
of
you
it.
into a fight with
Yeah.
No,
people.
trend following is technical analysis.
Trend following is technical
It's
analysis.
not pattern recognition. It's not like Ichimoku nonsense, but no offense, but it's technical.
To me, the trend following is
Oh, wait a minute. You don't consider yourself a technician. You're a quant,
I'm neither. I'm just like a pragmatic person who.
an astrologer. What do you call yourself? Like your discipline? You don't tell people you're technical?
No, I just
You're a trend follower.
I'm just a trend follower. I'm just an investor.
So
I
that's
just
its own.
have
That's its own world, basically.
It's a universe
following.
within technicals. It absolutely is. It's right within the CMT. Trend following is.
But
a big
he's not
component.
looking for patterns.
When I
understand.
So in my world, and it's like I think of market technicians. Like I have a pattern. Here's a chart. I think this is going to happen. It's like the William O'Neill, Can Slim,
DeMarc.
IB.
Yeah.
There's no back testing, objectiveness, right, to these things. Like I'm like more like an actuary, right? Where I can look at the probability distribution of all of the data and say, hey, here's the actuarial distributions. I'm coming up with the math of what I'm doing based upon, that. And probability distributions, I'm not like chart patterns or whatever. I'm not saying they're like related. It's kind of like
They're related.
cousins. Like, oh, look, there was a breakout.
Well, what
You can
they're
look at
both
this
focused-
Because
chart.
breakouts happen in uptrends.
Yes.
Obviously.
Yeah.
But
they
what
happen in downtrends.
where they're related is that it's a focus on the price
Yes.
versus a focus on the underlying business or who's the CEO or what products is the company about to launch. That's where they're related.
That's true, but for me personally, I also come back to at the end of the day, price trends are all going to come down to fundamentals. I mean, like over time,
Yes.
companies that grow their earnings, companies that grow their competitive advantage, companies that grow their earnings power are the ones where their equities are going to go up.
You and I completely agree on that.
It's not like magic where it's like, oh, there's a chart and it goes up. Like there's a reason that this energy or this fuel exists for these massive 50 bagger, 100 bagger companies are solving problems in the world. They're creating real value. The marketplace is rewarding those companies with superior profit margins or whatever it be for the value that they create in the world. You can't divorce those two from one another.
You will never
You
see.
can short term, but long term, the voting machine versus the weighing machine. You're right.
Yeah.
If you zoom out even to a monthly basis, revenue, maybe not revenue, net income, free cash flow, price follows that. It just does. Not every day, not always, but over time they converge.
Yeah, and I'm different from a trend following standpoint. Most people, when you think about trend as a category or trend following,
I think about commodity
funds,
traders and
commodities, currencies,
CTAs.
CTAs, like that kind of world. That's the unit. They're multi-asset portfolio. It's long short. They're selling low correlation. Maybe they make money in a down market, but they're not. They're just trading trends. Like if you ask, well, why do these trends exist? Why do you make money? I don't really have a great answer for that. Like, what's the DNA?
I just know
of
it works.
corn?
I don't know
just
why.
know it works.
Why
I don't
you
know
short
why.
sugar?
Yeah.
Because it went down. I'm like, that's fine. It can be in the data. You're like, well, the math says it works. Look, it's worked historically. On the stock trend following side of it, it's like I can tell you, I am supremely confident that the system of capitalism and the taking risk and innovation, the rest of is going to create massive winners. There are going to be companies get created and formed public, and they're going to be huge winners, 50 bagger, 100 baggers, and that's going to leave behind, and they're going to create massive economic value, and that's going to leave behind these long-term trends.
Yeah.
And a trend following strategy is going to benefit, from that. And I like it's like an ongoing system that would just pump out these things. I don't feel that same way or can't make that same argument for why is there going to be a mega trend in short corn.
Yeah.
There are risk transfer markets, hedgers, speculators. I know there's this whole other argument
there's
about
supply, demand of the underlying. There are mechanical issues with delivery. There's like a lot
there's a
more
lot of
that's
stuff,
involved.
kind of going on in the stock world, though. Like I don't know, it's just very simple. I'm confident that they're going to be massive winners. I'm also confident there's going to be a bunch of shitty companies and stocks that go to zero, and you have to do kind of both. And trend following is a fantastic mechanism for ensuring that you own those future winners without having to be very good at predicting them. And more importantly, or equally important, it's good about clipping aggressively the losers that are going to be destructive to your life. I mean, most people that are running businesses are not good businesses. Most businesses are bad businesses, mediocre managers, people that are diluting the shit out of shareholders. Like they're not, it's a minority of companies that actually are these great quality businesses that have real competitive advantages that grow and turn out to be mega wealth creators for shareholders.
So you mentioned looking at 100 or 200 years of data. Do you have to, in the way that you formulate your strategies or the way you execute, do you have to like update and account for the fact that, as we talked about, everything is faster and the length of time that it might have taken for a bear market to become a bull market again in the 1970s is going to be a very different length of time as it is now? Or can you like just look at the fullness of a data set that long and just say, human nature is what it is, and whatever would have worked in a back test historically would probably still work?
I think it depends on what kind of trend follower, like when you say there's different speeds at which people do trend following. If somebody might have been a short-term trend follower, or maybe more like momentum guys, I would put in the short-term category. They're buying and selling, maybe they're average hold time, swing traders.
Yeah.
The stocks that we own in our process are held in duration for multiple years. Like we're capturing mega trends, things we own for a long period of time. And by being in stocks that make new highs and just sitting on our ass and waiting for them to kind of play out as they continue to do it and not interrupting the compounding of winners that you have kind of in your portfolio. So what I would say is, yes, market speeds change, stuff evolves over time, but a new high 100 years ago, and the math of it is the same thing today. There's no difference between a new high 100 years ago and a new high today.
So that's very important. And one of my weaknesses, and I think this is common amongst all discretionary traders, is the temptation to sell your winners, right? Because we know how hard they are to come by,
Yeah.
so you want to lock in your gains. Josh is very good at it. Josh has been in Shake Shack for 11 years, Nvidia for a decade. Like, he's very good at that. I'm not. So I have all of these stocks today hitting my screen that are at 52-week highs, and I am fighting the very
Can't wait to sell them.
I am fighting the very human urge to lock in profits, especially the way that we just had this V-shaped rally. So how do I know when the trend has changed? Like, what do you look for to know that the trend is broken?
I mean, there's a lot of different ways.
Tell me the answer.
that anybody, could do it. But, somebody could run a very simple moving average, 200-day moving average, number, or 300-day or 200-week, depending upon the speed and time frame that you're kind of looking at. That you don't have to be a rocket scientist to figure out what is a trend up, down, to get in, to get out.
I love that answer.
Yeah,
What indicators other than moving averages are relevant to your work, if any?
the only thing that really matters to us are, new highs, new lows, and what's the kind of volatility of the stock. Because if you're
Average true range?
like average true range.
So you want-
I think
want
that's
us-
a powerful
Yeah.
tool that doesn't get talked about enough. Can you
Becau-
explain to the audience what average true range is and how a trend follower would utilize it?
So an average true range is recognizing that different stocks have different volatility profiles. So if you kind of look back the last 90 days, there's 500 stocks in the S&P 500. Each one of those is going to have a different path traveled in that 90-day box. If we use volatility as a risk proxy, and you want to have a portfolio kind of had equal risk between the two positions, then you wouldn't want to have the same amount of money invested
So
in
it's
a
a
stock that's
position sizing. This particular position has an average true range, let's say, of 5. This one is 2.5. You would want to own double the amount of the one with 2.5 because you're lowering the volatility of the whole portfolio.
Correct. And you'd have equal kind of proportional risk between the two positions. Also, if you think about a trend follower, it goes into the stop loss calculation. If you have a high volatility stock and you put it the stop very close, in a volatile
You're going to
stock,
chop yourself up.
You're going to get chopped in and out of that. If you do the same stop loss and something has less volatility, it's not going to be as sensitive. So it has an effect also on the stop loss and how much you get whipsawed, kind of in and out. So
in other words,
like you can't use a 10% stop loss on like the William
Right.
O'Neill IBD thing, because if I have 50% volatility, I'm guaranteed to get stopped out in a 10% stop loss, maybe not necessarily in something that's much lower vol.
So let's take a name like Nvidia as an example. Nvidia is a stock that can go for 3 months nowhere, and then it can go on a 6-month run where it makes a new high every week, right? When it's trending higher, you look at a 21-day ATR, it's probably tight because the stock's not going up 8% a day.
Yeah.
It's going up 1/4 of a point a day, but it's driving people crazy because it doesn't let them in. So it's got a low ATR. It's making highs. It's unfortunately too far above its moving average for that to be a useful stop. Like you talk about some of these Nvidia rallies we've seen. There have been periods of time where it was 100% above its 200-day.
Yep.
Like what the hell are you gonna do? That's your stop? Okay. So those are the types of stocks where you have to say to yourself, I better take a look at least what its beta is or its average true range so that I don't put a stop in that I get hit on tomorrow. Like that's the kiss of death for trend following.
Yeah, if the kiss of death, doing that.
The kiss of death.
He said the
kiss of
kith.
death.
The kiss of death. All right. I'm looking at you. You taking a picture?
That is a mouthful.
All right.
But the other thing that you can do, and this is what we do, is you also have to remember you can be in a trade and volatility profiles change. They're not static. They can be high. They can then rotate to low. You can adjust the position size through the cycle. So in that world where Nvidia is way above its 200-day, and like, well, the distance to stop, if my stop is the 200-day moving average, is very far away, and you're uncomfortable with that delta or the risk there, well, you can take some of the position off to reduce the open risk. You don't have to change the stop loss or the robustness of it. You could just change how much you're exposed to it in order to be happier.
I like the answer that you gave earlier about it. You're like, I don't know, 200-day, 100, whatever you like. I think people tend to overcomplicate the shit out of it. It doesn't. The more bells and whistles, the more inputs, you're not getting more precision. You're just getting more noise.
It doesn't matter. It matters if you're too short term, it's not robust and you're just trading in and out. But if you get outside the noise factor, it doesn't really matter. What does matter is that you execute it
consistently
and
Yeah.
robustly and take every trade and do it. That's the part where people mess it up, right? They just
Well,
don't
if
have
you
the
start
ability
cherry
to be that
picking,
disciplined.
all right, I'm about to get stopped out on this, but I think they have a big announcement coming Monday. Like if you start down that road, then you don't have a process anymore. You have what most investors have, which is just random.
Dude, you can't ignore your intuition.
Right. But I'm saying you have to decide at some point early on, especially if you're a professional, this is either science or it's an art project. Some art projects turn out really well, but if you're selling that as science, that's really bad.
Yeah. I personally don't recommend trend following strategies for average, investor, people. I think if you like the strategy,
All of our listeners are above average investors. Thank God.
Yeah.
Yeah. We're safe. We're safe. I want to talk about your does trend following work on stocks and then why you chose to update it in January of this year. In quant circles, people refer to it as a landmark paper. Do you know that?
No.
Okay. Because I was doing some homework.
What is a quant circle? Because that sounds like
in
not
some
a good
circles
thing.
where people talk about equity market research, there are people who have referred to your paper as landmark. So I threw that in there.
Okay.
Why was that? When did you first write does trend following work on stocks? And why do you think there are people who look at that as a really important thing that you published?
When did we do it? 20 years ago. So
2005. Yeah.
Was the publication of that paper. And for me, I was doing trend following and I was allocating, like running like a hedge fund of funds, and I was investing with trend following managers, but they were multi-asset, long, short, currency, commodity. That's the typical traditional trend following thing, the CTA world that you see from. And I asked them, like, how come you don't there's all these massive trends. Here's the data of individual stocks. Why don't nobody in the entire industry, there's like, hundreds of billions of dollars invested there. Nobody was doing trend following on stocks.
Meaning they would trend follow an index.
Stock index.
Like the futures.
Yeah.
But you're talking about at the individual security.
The very specific individual
I'll tell you why nobody
security
did
level.
it, because it probably took you forever. It's probably a huge project.
It was a huge project, put the stuff together, whatever. But I mean, these are multi-billion-dollar hedge funds. Like they can figure it out. It's not like with all these PhDs on staff. Like it wasn't. They definitely could do it.
Okay.
And I think it's just a bias where they're in the futures world. They're comfortable with these indexes. But I was like, so there was just a really untapped opportunity. Nobody had done the work. And we saw it as an opportunity to go and like, let's do something that was new. Nobody needed another research paper to show you that trend following worked on corn. Like that had been done so many times by so many people. And that's where it kind of came from. And I was kind of shocked that nobody had done it. And then we decided to turn it into an investable product. I'm more shocked that 20 years later, we're still the only firm that I know of in the world that's like actually running a fund and doing this.
So what happens after you publish this? What are the conclusions from the 05 paper?
The 05 paper, I would say three conclusions. One, it was definitely a robust, like it works effectively on individual stocks, and you can build a better stock market mousetrap. Better, not meaning it makes more money than the stock market after all transaction costs.
You're focused on like risk adjusted.
The risk adjusted returns.
Okay.
You can get the same or slightly better return than being a passive diversified equity investor, but do it with substantially less drawdown, substantially less volatility, correlation, beta, whatever, and then ultimately a better emotional experience. Like your behavior is going to be better if you're in a stabler ride along the way. So that's kind of what I mean by better. It's not something that's going to like double the rate of return on the stock market. But if I get something with way less risk and a better emotional experience and get the same, and it doesn't cost me anything. It's like actually I'm getting the same thing as an index or better. That was my definition.
What were the other
better.
two conclusions?
That it was very, very uncorrelated to multi-asset trend following.
Oh, wow.
So, you have $300 billion right now as an industry that's allocated to multi-asset trend. And this trend following on stocks is very uncorrelated to that whole sector, and it has like 3 times the return. Last 10 years, the SG Trend Index, which is like the hedge fund index of the
it's not great.
2%.
Yeah,
but people love it because or they use it because it's the most negatively to non-correlated asset. So it's a great portfolio diversifier. And it has the potential to make money in a market crisis like once every 10 years.
Right.
So, but in the last 10 years, like you would have been much happier with us as running this trend following thing on stocks in the compounded annual growth rate that you got, and we have lower drawdowns than this
So
diversified.
it didn't look
multi-asset
like
thing.
the other funds that are in this basket.
It doesn't
Okay.
look like the other funds in the basket. It has the same style, same risk management, same philosophy, everything, but it's uncorrelated. So it makes a great diversifier. Like putting them together makes the investor experience of investing in trend. Like you're way happier with that experience than kind of I owned managed futures or systematic trend for 10 years. I was happy in 2022 and I was angry every other year because of the underperformance drag and things like that. So
Are you SMA only or a mutual fund as well?
we run a mutual fund and we offer SMA if people wanted to do an SMA, but our primary product is a mutual fund.
All right, so you put the paper out and you built the fund based on the findings.
Yep.
So now that we know A, B, C, and D, here's how we would build the mousetrap that people could actually put money into.
Yes.
Okay. Now you did that in a time before active ETFs. Like there's really no such thing at that time. There's ETFs, but most active strategies are in mutual funds. If you were starting today, would you have built the product differently? Would you start with an ETF?
If I was doing it today, I would do an ETF.
Okay.
Only because, and we will, you asked me what is the most thing that I'm most excited about, in the future is the, hopefully the coming potential of mutual funds being able to ETFs as a share class. I think it's gonna be great for the industry, levels the playing field.
Yeah.
It's gonna be great for consumers. It's gonna lower price, increase access, choice.
The taxable ramifications.
Yeah, all of the
Right.
above.
Okay.
But I would do the ETF because that's obviously like the vehicle of choice.
This is what people push the buy button for these days.
Yeah, that's kind of like VHS, was
Right.
the mutual fund structure. The DVD is the ETF, and then like going even beyond that is streaming is like the next generation, maybe tokenization of stuff or whatever.
It's
So we're
weird.
not there yet.
There's an ETF for almost everything except for individual trend following stocks. As far as I know, there are ETFs that do trend following on large cap indexes and probably other indexes, but I don't think I've ever seen one on individual securities.
I don't know of any company or any manager in the public world or even the private world that is doing systematic trend this way on individuals.
Well, think about how many decisions you have to make to do this. Number one, you have to say, well, if I'm only buying stocks that are in uptrends, right? What if there are no stocks in uptrends? Like that's a thing that's going to happen at some point. What do I hold when I'm not in stocks? Like what's the default risk off position or positions? 3, is there going to be a sector cap? Like what if it's all tech stocks? Do I just own all tech stocks and nothing else is an uptrend? Like you have to make each of those decisions along the way to come up with an idea, which requires a ton of testing. And like a lot of companies are just going to default to doing something easier.
Well, they're going to do something very simple in that way, or they're going to try to concentrate in one sector. Can you get it down to 50 stocks? And it's like, well, I could if I knew which one of those 50 stocks are going to be the winners.
Yeah.
The reason I have to do the Russell 3000 as a total starting point is because I don't know what the next big
You
winner
have to
is
be
gonna
where
come
the
from.
momentum is. You don't know how many stocks that's going to be. You don't know what sectors.
Yeah.
So you
d-
cap weight it at all or cap adjust?
No, it's the opposite of that. So we've all weight or we risk weight each position. So we tend to have very small, equally dispersed positions across, everything. The delta between our largest position and smallest position is not nearly as big as what you would see like in a cap weighted.
In a healthy uptrend, how many
Index.
stocks-ish would you own?
Like 500 to we tend to own about 20% of the investable universe. So,
Okay. And then when you risk off, what does the portfolio look like? Is it like T-bills or
Pudgy
is it
peg- pudgy
less
peg
stock?
ones.
How do you do that?
cash and T-bills.
Okay. All right.
Yeah.
Have you ever experienced a reconstitution where your gut is telling you, "Oh my God, I really hope the rules let me sell because I want to sell right now"?
Every year.
Okay.
I mean,
is that-
HIMS. Do you think I really want to own the growth stock of HIMS? Get
Right.
the growth stock?
right, but your rules are your rules, and you have to just knuckle through it. That's like part of the deal.
Yeah.
If it's rules based, it's rules
Or
based.
we bought. I remember in the crazy COVID time, we bought GameStop. Came into the portfolio. The breakout was like that wasn't.
Like,
But on the flip side,
no.
when you have a quick
No.
trend change and HIMS shrinks, get it?
Yeah.
You got to sell.
Got to sell.
Okay. What do you compare yourselves to when you're showing the fund to family offices or wealth managers? Like, what box do you put yourself in?
Systematic trend.
Okay.
But not because we do what everybody else is doing is systematic trend, because we're doing something accretive that adds value that's low correlated to their existing strategies. So
Right, you're not showing yourself against the core long stock ETF.
No, and it's like it's not really. It's kind of a waste of time to talk to an investor who doesn't believe in trend, right? So first, we want to like find people who have already invested in this space. I'm trying to convert people that this like you're already converted. You have invested in this strategy. You like it, but you're not very satisfied maybe with the experience of this multi-asset trend, like the streakiness of it.
That's a great conversation for you. It's like, look, I know you get why this is worth doing. You just might not have you have the wrong boat.
Or you have a insufficient, kind of boat. I'm not saying multi-asset trend is bad. I'm saying it's kind of incomplete. If you put in this, there's the benefit of adding trend on stocks, or what it is that we do is that you're going to get something as a 3x higher CAGR there, and it's very, very low correlated to what you're doing, but it still has all of the risk management, the trend diversity, and so those two component pieces blended together is going to give you a much smoother ride, a much more consistent ride relative to just owning multi-asset trend standalone, where you're happy once a decade.
John, can we see chart 1 on screen? So, like into the stock select. Well, first, what are we looking at here?
These are the 10 largest AUM systematic trend mutual funds.
Okay, so
over
this
the last,
is the universe
over the last
that you're comparing yourself to, basically.
Yeah.
Okay, so I gather these look very different under the hood in terms of what they're doing. Why is yours so far away from all of theirs on the correlation matrix and on the returns matrix?
The blue thing, the SG trend, is the benchmark. So that's an index of like the 10 largest systematic trend hedge funds. And then the other ones are the mutual funds. They're trying to give you some return there. So you can see they're all very correlated to the index because they're all doing long, short, multi-asset trend. So some varying degrees. There's very little differences between them. Ours is over here. We don't do multi-asset. We're just doing specifically stock trends. Has had a much higher ability to generate a rate of return. And the way it makes money and when it makes money, how it makes money or loses money, underperforms, outperforms, is obviously just very different than if you have a portfolio that's 4 asset classes long, short. It's a totally different underlying
holdings. So it's so funny. You reached that conclusion with data. We reached that conclusion with behavior. So we know a couple of things about our clients and like individual investors in general. The first thing that we know is, for the most part, the FOMO that causes an investor to abandon their strategy or fire their advisor is like 90% about the S&P 500. Meaning, the Kospi in Korea is up 30% this year. My clients don't have FOMO about South Korea. They don't give a shit. It's not relevant. So the first thing I know, if I'm building a strategy that's a risk management strategy for trend following, is I'm not going to include long, short, neutral, whatever, to asset classes that aren't relevant to the client's behavior. Because what we're trying to do is manage people's behavior.
Yep.
So in the case of FOMO, we're trying to make sure that clients don't see the market galloping away from them and why aren't I more long? Okay. So right off the bat, I'm not interested in multi-trend. My clients don't know what corn is doing. They don't care what oil's doing. They're unaware of foreign markets for the most part on a granular basis. It's not important to them. I will get fired if the S&P has a 27% year and I'm way underweight. 100% I'll get fired.
Yeah.
So I already understand that very basic premise. So adding more bells and whistles to our strategy, why don't we put Bitcoin in? Why don't we put this in? Why don't we put that in? Right off the bat, no. Because that's its own world. This is about stocks. If we're trying to manage people's behavior and psychology, stocks. Like that's the first way that I thought about it. And you're kind of doing a similar thing. It's like, look, yeah, there are a million things that you could trend follow, but we're doing stocks.
Yeah, but our clients are all financial advisors. I mean, that's who we work with. And I also ran a multi-asset.
You've seen it up close.
Yeah, fund.
Yeah,
so, I mean, I in 2012, we launched a multi-asset fund. We were top performing fund. I raised over $1 billion for the fund and then watched it go from $1 billion to zero from 2016 to 2020. It didn't go to zero because the performance was, bad, or the strategy didn't work or didn't deliver low correlated returns. Is because of the the relative underperformance, of the
Yeah.
S&P 500 to that thing, the statement risk for financial advisors.
Yes.
Statement
keep
risk is a really key thing.
defending it every year in
Becomes
and year
impossible.
out.
Why do we
eventually.
own
How
this?
do you
Why do we
defend
own
this
this? Why
thing
do we
for
own this?
9
Yeah,
years
yeah,
with your
yeah.
client going, no, you're like, you just become Chicken Little.
Yeah.
And your clients don't want to hear it. And meanwhile, the advisor down the street's like, your advisor's an idiot.
Mhm.
He doesn't know what he's doing. He's got you in some high fee managed futures. Like,
Yep.
what is that?
But on the
and you get
institution,
yanked.
but on the institutional side, statement risk is less or more because they're sophisticated and they can ride strategies through a bear market for that strategy, but maybe not as much as people would think.
It's different. I think the psychology of what they're benchmarking against, they have their own psychological biases and things that are affecting that, but it's different than the kinds of emotions that are affecting. In the institutional world, my experience is there's a lot of herding. As long as you're doing what XYZ down the street is doing,
Yeah.
I'm cool with that. If you're all in the same club, if you're all investing in Bernard Madoff, I'm going to invest in Bernard Madoff. They're not even really thinking about what's the underlying due diligence. So if everybody says trend makes sense and go there and the consultants say that it's okay, they're going to stick it in. And
Well, I
kind
was
of
going to
do
say,
it.
and part of what drives the herding is fear of reputational risks. So if everybody believes in this manager, I'm not picking on anyone. If everyone's like, oh no, Bridgewater, that's like the way to do that for global macro, then everyone's in Bridgewater because no one's going to look like an asshole to their client, even if it goes down.
And the decision making, I think a lot of it is just like protecting career risk kind of thing. Like I'm just going to do the thing because if we all invest in this and it doesn't work out, it doesn't matter because everybody's kind of getting fired. And they're not the owner of the capital. See, when you guys are working directly with the owner of your capital, and then you're working with the emotions of the owner of your capital, and you can't be in a state of conflict between you and your investors, the actual retirees. You won't survive.
We will not stick with an asset manager that forces us to apologize to clients every quarter. Why are you underperforming your peers? Why are you underperforming your benchmark? Why we can't because we're like here to have a career.
Do you notice better behavior? Speaking of behavior, do you notice better behavior amongst investors in your mutual fund versus your SMA? Because inside the SMA, they could be like, wait, why is he selling Nvidia? Or why is he selling Tesla?
Oh, that's a good
like,
question.
are they less likely to boot you if they don't see the underlying?
Because they don't see what you're doing in the mutual fund until 45 days after the quarter ends. But they could see what you're doing in the SMA daily.
I think for me, it just matters like what I would say what are the returns? Like at the end of the day, I think it all comes down to did it work or did it not work relative to what they wanted it to. When we see redemptions and people leave is when you have a drawdown, you lose money. Maybe they recently invested and then the market goes down like, oh, I don't know about this. And then they kind of like short-term turnover. But for people who kind of are in it and stick with it, this strategy, well, I'll tell you this, compared to multi-asset trend, we have a lot higher retention rates and a lot higher client satisfaction with this trend approach on stocks than we did with multi-asset. That is like,
I think because
obvious.
I think because it's easier to understand what you're doing. Like if you're a trend follower multi-asset, you could literally be doing anything. The portfolio could own like almost anything. Stocks is stocks. So I think that retention is like people get what they're doing in that strategy.
Yeah, but I think that if stocks are stocks, but if I delivered a 2% return,
Yeah,
I don't think they'd be very happy with that.
What are there certain asset classes that lend themselves better to trend following than others, and why do you think that is?
Well, yes. So, asset classes, I don't know.
Certain commodities or certain instruments.
I think
there's some that just flat out don't work.
I mean, historically speaking, like cocoa didn't work for like 100, it was like very long decades and decades didn't work. And then it recently worked, but you would not have you would have been better off without having cocoa for those decades prior to that.
Worked meaning it conforms to something that you could chart and you could.
Like you made money trading it that way. I think cocoa just constantly was like a false signal trade. You just basically did nothing but be a money furnace if you were doing trend following on cocoa. For me, I think markets that have large risk premiums and that are not efficient create bigger trends. But trend following works better or best on anything where you'll get large outliers that come from it. Like this individual stocks, you can get a 50, 100-fold return from an individual company. That's going to leave a trend.
Well, speaking of large outliers, did you ever try crypto, like in your personal account, trend following on that? Because it works very well there.
Well, I don't trend follow in crypto. I've just been like a diamond hand hodler, of it. But it does work if you just bought the high and had like a Carlo Zaratini from the Concretum Group, who we co-authored the paper with, wrote another paper, not with me, but with his group, that did trend following on like all of the coins and the efficacy of it. It's actually a great.
I would imagine it worked very well.
Yeah,
but that's part of the robustness. If you say this works here, the next question is, well, does it work international stocks?
Yeah.
Does it work small caps? Does it work crypto is now a legitimate robustifier, if you will. If you're doing like research, does this work?
Yeah, but one of like, as an example in our thing, largest public company or the public company that has the largest Bitcoin holdings is MSTR and MicroStrategy, and we've owned it for years. So our trend strategy picked up and having MicroStrategy in there.
Probably have Coinbase right now.
Coinbase, other ones that have the exposure. But so, but the point about trends is you should not do trend following on something that doesn't have the propensity to have those outlier, movements. So if you think like, why would I want to do trend following on the S&P, like the 500 largest, most diversified kind of thing, all the world's intelligence discounting the price on it, versus doing bottom up trend on idiosyncratic trends of individual companies where they're less efficient markets. You're going to get these monster trends that kind of come out of it if you're trying to create something that is a different return stream than a market index.
So I want to ask you one more question on this. Why do you think we haven't yet seen trend following sector funds? Because it strikes me that that's a real opportunity that people would be interested in, just from a marketing standpoint. I don't know if it would work. But like if somebody said, okay, I love what you're doing. I really don't care to earn the return of the S&P 500 that way, but I'm really interested. Give me semiconductors, but I only want to own the ones that are going up, and I want the risk management from trend following. Or give me biotechs that are trending or something. Like, why haven't we seen those yet? And should I launch one?
Maybe.
Okay.
But they didn't work, the sector rotation funds. It got blown up. Are you describing something else?
I don't think I'm saying sector rotation. I'm saying picking individual stocks in those sectors.
What'll happen
You see what I mean?
The trend following will work on all those sectors. Let's say you just created a platform and I'm going to do trend following in every sector. And I'm just going to have the sector strategy. It owns top performing stocks in each one of the sectors.
But a separate fund for each.
Yeah, separate fund for each
So
one.
give me, let's do tech stocks.
Yeah.
Give me trend following tech stocks. That would be a hot product.
Right now.
At least right now.
Yeah, right now.
Well, that's all that matters.
Yeah.
We'll worry about the future in the future.
But I'm saying, so it would work. What'll happen is you'll have huge dispersion of returns from strategy A to strategy Z, depending upon what was the best sector. So energy, probably in the last decade, would have sucked,
stipulated.
and tech would have been great.
Same way if you just bought the sector straight up. If I just buy like the oil services stocks in a sector ETF.
Yeah.
Granted, it'll have great seasons, it'll have terrible seasons. This is life. But what if I said, I want to own the sector is clearly in favor, but I want the extra return that comes with only owning the best stocks in that sector on a trend basis. It's just weird to me that nobody did this yet.
Yeah, we definitely could do it. I mean, we could do it for you as a custom SMA if you want.
Okay. Why do you think it hasn't been done? Just we haven't gotten there yet? Or the interest isn't there?
I mean, we don't even have another fund other than us that's doing trend on individual
It's
stocks.
crazy,
so
right? All right. So you're still like a pioneer. It's still early.
Still early.
Okay. Anything we didn't cover on the trend following side, or anything that you think is like a big misunderstood piece of how this all works?
Thoughts on the mayor? Anything?
Anything about the
Not
socialist
touching that.
paradise
Yeah.
we're about to
Yeah.
build in New York City?
Lovely.
Yeah.
Yes.
It'll be great. What could go wrong?
Okay.
Any parting thoughts on trend following?
The parting thoughts on trend following is I know there's a lot of investors in trend following, today that understand the non-correlated benefits of it and have it in their portfolios. But I also know that they're not 100% satisfied with the experience of owning trend. And
Call me. Okay, got it.
yeah, exactly.
All right. Dude, this is so much fun. Did you have fun on the show today?
Yeah, it was great.
Yes? All right. We always end the show by asking people what they look forward to. Your answer is ETFs is a share class of existing mutual funds. Isn't that already legal, or they didn't approve it yet?
Not yet, not to my knowledge. I think it's still in the.
Well, why
pending kind of
Vanguard
stuff.
does it currently? They have an exception.
They had an exemption from the SEC, and then they're the only ones that have been able to do it so far. But everybody's lobbied, like, everybody's filed the application. Kind of like when everybody filed the Bitcoin.
Yeah,
they're lining up. They're like, well, wait. So it's a hurry up and wait situation.
You think that's going to happen now?
I do.
Okay.
I think in this administration, it's going to happen.
Why does this matter? As somebody who operates a mutual fund, what will you be able to do as soon as this happens?
Well, it's a cost savings. You can launch an ETF on the same wrapper. I don't have to start a new fund, take on all the extra CapEx associated with all the operational expenses. So by being able to have a share class of an existing fund, I can take that operational scale, offer my product and services to ETF buyers only, new generation of people. But I can also lower costs because I'm expanding my total addressable potential market without increasing the cost burden. And I'm able to transition, like why was it good for Disney? It had all this content when DVDs came around because it gave them a whole new market with the existing content. They didn't have to go create new movies. They just were able to put it over here.
You know what I would do if I were a finance person without a job right now, looking for like what's the next opportunity? I would set myself up as a consultant to open-end mutual fund companies. I would be like the conversion guy. Like, pay me consulting fee. I'll come in. I'll show you how we can create ETFs as a share class of your existing funds. And it'll be a project basis, how you pay me. I feel like somebody could start that business right now and make themselves a couple of $1 million a year. What do you think about that?
Yeah, I mean, I think there's a need, just like there's a need for AI consultants to show people how to kind of do it.
Like if somebody called you up and said, all right, are you ready for this? The SEC is about to let you create a share class. And you were like, well, I have some questions. That person quoted you a fee. I'll tell you what, hire me. I'll help you do this. You pay it.
I'm sure that McKinsey is going to be making millions off of this, for people giving them like a whole deck like they've do with the New York City, where like I saw this presentation here and it was like about millions of dollars to show them that they should get containers, like trash cans. It was crazy.
Yeah. Okay. Michael, what are you looking forward to?
I am looking forward to no more travel until Future Proof in September, shutting it down.
You were just in Chicago this week?
Yep, done.
Those overnight trips
tired.
They kill you, right?
Yeah, I'm tired.
It's a lot of turnaround.
The Lake Como I'm going to, which we talked about this.
Yeah, when are you going?
Last week of July. So first week of August.
Okay, I'm leaving.
I'm excited about that.
I'm leaving this coming week, so I'll let you know. I'll let you know if I come across anything I think you should know about. How long are you going for?
2 weeks.
2 weeks.
Yeah.
How are you able to do it? All right, I'm going 6 nights. I'm going for 6 nights. Are you staying on the lake?
Yes, we're staying at the Mandarin Oriental. So,
ooh, what town is that in?
The Mandarin Oriental should comp my room for plugging them on the show.
What town is that in?
Do you know? I don't know.
All right, I want to check out like all the hotels I'm not staying at. I think I'm staying at a good one, but I want to like make sure that I see everything.
Yeah, there was another one we were going to say. I can't remember the name of it, but it was like really, I found out you had to wear like a dinner jacket and be super formal to go to dinner. I'm like, I don't want to.
Oh shit, is that where I'm staying?
You might be staying there. It's a beautiful place, but then I found out that it was real.
Okay.
Gonna be like, eh.
All right. I'll after the trip, I'll send you my itinerary. I'll let you know what we did. Cool. Are you flying into Milan?
Flying to Milan, spend a few days there.
All right. Well, you and I have the same thing that we're looking forward to. So that's mine for today. I want to thank the staff this week. You guys absolutely crushed it. We did some amazing stuff. Michael had Dave Nottig on the Unlock channel if you're a financial advisor. We are putting out extremely high quality conversations on the Unlock. Make sure you check out Dave Nottig talking with Michael Batnick about how AI will affect the financial advisory world. I had Rick Edelman on earlier this week. If you missed that, that was a good one on crypto and Rick's recommended allocation. And we did a whole animal spirits. We did everything. We did it all. Guys, thank you so much for watching. Thank you for listening all week. We appreciate you. Like and subscribe. We'll see you soon.